Thank you so much. So today I have for you Whole Life Yoga with Manulife Par. Again, my name is Andrew, and joining me today is my friend and colleague Cody Hill, who will be manning the Q&A session or the chat box that we have with WebEx. So I'm not sure if we'll have enough time at the very end to have a standalone Q&A session, but certainly as you have questions throughout the session, please put it in chat and Cody will answer those for you. Now, the agenda today is fairly straightforward. I'm going to take you through some of the features as to why Manulife Par deserves the moniker of Whole Life Yoga. I'm going to take you through some case studies that really are the inspiration as to why I came up with this name for Manulife Par, and I'll close it out with some final thoughts. Now, before we dive into the meat of the presentation, just like to post up the CE credit code for today's presentation. If you've been to a Manulife webinar in the past 2 years, you're probably familiar with this process. The code highlighted at the bottom is the first half of today's code, so please make sure you jot that down. It's today's date, 09/30/2021 _XKZ. Yes, it is case sensitive. Now, this presentation is already accredited with Advocates and FP Canada. For those of you out in Alberta and Manitoba, it's pending with AIC and ICM. So when you put this code into your advisor portal, it's going to say pending, but as soon as it's approved, you'll be able to get your credit. So I'm going to leave this slide up for about 5 more seconds, and then we'll go on to the next slide. 5, 4, 3, 2, and 1. I'm not able to share this slide after the call, so please make sure you jot this down. So, what is Whole Life Yoga? Now, the inspiration of this presentation is a result of a number of casework that I've done with my advisors in my territory, where it really inspired me to think that Manulife Par provides an unparalleled flexibility to fit in a myriad of client situations. Now, there are certain features about Manulife Par that makes it flexible. And flexibility is the name of the game today. Right? As we stretch and we bend and we mold this product to fit with our unique client situations, it reminds me of a yoga session. So I'm going to structure today's presentation in that same theme. But to speak of the features of Manulife Par, there's a number that I think is worthy of mentioning. First one is our default lifetime deposit option limit. Now, some might call it Premium Plus. We call it ADO, or Additional Deposit Option. But with every Manulife Par case that comes through the door, we provide a lifetime deposit option limit by default. So it's something that you don't have to apply for. It's not something that we underwrite for. We don't require additional evidence of insurability for. It comes with every case. Now, what's unique about the default lifetime deposit option is that it's available for conversions as well. So as you convert a family term or business term policy into Manulife Par, we also provide the default lifetime deposit option limit for every one of those cases. You don't have to do the pesky net amount of risk calculation to reduce the face amount. It comes with the conversion as well, right? The next feature is how Term Rider adds Mpar room, or to put it simply, your annual contribution room for additional deposit option. Right? Now, of course, if you've heard the word on the street, there are a couple other carriers that have also added this feature onto their Par Whole Life product, but certainly Manulife was the first to market with this feature. And beyond that, we also offered unparalleled flexibility when it comes to timing. So when it's ADO with Manulife Par, your client can utilize this room anytime. So I call it ADO anytime. Your client is able to skip an unlimited number of years before using ADO. They can split an unlimited amount of years between their ADO payments, and there's no restrictions of, oh, you have to use it within 3 years or you have to use it within 5 years. So again, being able to give flexibility to the clients, even in the form of ADO payments, is certainly something that will fit in to this idea of whole life yoga, which we'll see in some of the case studies in a bit. And lastly, this feature, I don't think it's mentioned quite enough, but with Manulife Par, our paid up additions, PUAs, and our deposit option insurance, DOIs, are never rated, even if your client is of substandard risk. And this is something that will play into a couple of case studies that I'm going to show you. But certainly as you're going in your travels and you're meeting with your clients and you come across clients who are substandard risk, but looking for a whole life solution, Manulife Par is certainly deserving of your consideration. Now, before we dive into the first case, there is one misconception that I get a lot in the field from especially advisors who are just starting to work with Manulife Par, and they have this notion that due to the price, Manulife Par is only meant for high net worth clients. And this is a misconception or a notion that I hope after today's presentation that I can change for you, because for me, this statement that due to the price, Manulife Par is only focused on high net worth clients is certainly false. So let's dive right in to some of the casework and the case studies that I've done with my advisors in the past couple of years. And in the theme of yoga, let's call this our practice. So let's begin our practice today with the very first pose, which I called enhanced versus Manulife Par. So let's set the stage. We have a client today who is male, 36. He's looking for $500,000 of coverage. However, because he's in the family market, he has a limited budget. He needed to make sure that the premium stayed low, and so he opted to look at or consider Company A's enhanced coverage. Right now, right off the bat, Manulife Par does not offer enhanced coverages. Right? We only have paid up insurance, paid up addition, or cash dividend. We do not offer an enhanced coverage. And so because of that, when you look at just 500,000 to 500,000 comparison, you'll see right away the premium is drastically different, and hence there's a sticker shock. I'm going to turn on my laser so I can point you to the right place here. So Company A enhanced, that drops the premium down. Their total premium is only $7,600 a year. With Manulife Par, oh my God, $17,000 a year, right? And of course, all of this is paid up insurance. There's no enhanced, and that's a reason why for this increased premium. But obviously, with more money put into the policy, you would expect an equal amount of extra growth. And so when we push it out to age 85, yes, we have $2.7 million of death benefit compared to $1 million. CSV, $2.17 million compared to the $854,000 at age 85. But none of that matters because the client can't afford $17,000. Their limit here is $7,607. Now, when the advisor came to me, he said, I think I want to give Manulife a chance, but I'm not sure how I would structure your par policy to compare with somebody who offers the enhanced dividend option. And I said, well, look, with enhanced, when you look at the death benefit of $500,000, what is it composed of? Is it not just full of term? So one of the things that I talk to my advisors about when they're in this family market and they do a lot of enhanced coverages with different companies, I try to remind them that enhanced is just term. So instead of structuring the Manulife Par 20 pay at $500,000, what I did for this client was drop it down to $100,000 and then add a T20 rider for $400,000 so that we match the total initial death benefit of $500,000. But by doing it this way, we can drop that premium down. We can take a look at how that works. So Company A enhanced 20 pay, still at $7,600. No change there. With Manulife Par 20 in this solution, by dropping the par face amount down to $100,000 and adding a term rider, the total cost of insurance is only $4,000. Right? but we want to make it an apples to apples comparison with the premium. So what I've done is I've utilized our super flexible ADO and add that difference back so that we end up with a equalized premium between the two products, and we have an equalized death benefit starting at $500,000. So let's take a look at how the illustrations run. So the green line, obviously green for Manulife. You can see that we started the same $500,000, but there's certainly a much greater growth, especially in the early years. Now you might ask, well, what happens over here where there's a huge drop in the death benefit? Well, that's a term rider of $400,000 dropping off at year 20. Now keep in mind though, even though it drops, we still have a higher death benefit compared to Company A. In fact, Company A's death benefit only starts to grow in about year 26, and this is very typical of enhanced cases, right? You have an enhanced product, the death benefit stays level for the first sometimes 20 to 30 years because in those years you're trying to buy back the term option amount. Right? And as we push out to age 85, you can see that our death benefit, even close to life expectancy, has about a 17% advantage over the enhanced product. And this is what the cash value looks like. We are higher in cash value from day one. And what's important here is that, yes, this is a family mid-market segment where the clients are budget conscious. We don't have an enhanced product, but by pivoting and realizing that enhanced is just term and you can achieve the same logic with term riders, we equalize the premium, come up with higher values overall starting day one. So a couple things to consider in this case. Enhanced policies have a decreasing amount of convertible coverage, whereas term riders do not, right? Like I mentioned earlier, in the first 20 to 30 years, your death benefit on an enhanced coverage stays level, and the yearly renewable term amount of coverage is shrinking year over year, right? Now, you are able to convert the term coverage, the yearly renewable term coverage. However, every year, the convertible amount is decreasing. Whereas, if you did it as a term rider, starting day one, the client has the ability to convert up to $400,000 at any time. So if we go back to this chart, you can see if the client decides to convert at year 20, his death benefit, his permanent death benefit would start growing at about $900,000. Whereas if he decided to convert at year 20 with the enhanced, well, he's only able to ever get $500,000 to start, and then they're starting at a disadvantage, even if he converted the remainder of his entire yearly renewable term amount into permanent coverage. Okay, so something to consider on the conversion front. Secondly, with this case, Manulife Par actually offered $66,000 of lifetime deposit option limit. I apologize for the acronyms, but I didn't want to make the slide too busy. So LDOL is lifetime deposit option limit. This deposit option limit was not applied for. We didn't request any evidence of insurability, and it never expires. And so at any point during the lifetime of the policy, this client was able or is able to put in ADO into his policy to further the growth of that policy. And just to remind you, if he did choose to convert that $400,000 of term rider, that new $400,000 policy, if it was Manulife Par, would also come with its own deposit option limit, default deposit option limit. Again, not something that we need to calculate net amount of risk for. It will come with the new policy. When it comes to Company A, it did not offer any ADO room. So to sum it up, equalized premiums for someone who is budget conscious, but we were able to provide better values because at the end of the day, enhanced is just term. So done with the first pose, on to the next one. The second one is we're going to call this rating buyback. So this harkens back to earlier when I said it's a relatively unknown feature or something that we should certainly promote a lot more, but paid up additions and deposit option insurance with Manulife Par is never rated, right? So here's the case: is male 35, non-smoker, $500,000 of coverage. He came into Manulife, but after underwriting, quite unfortunately, he was rated 250%. And again, we have a case of sticker shock, right? So the original case, the total premium was $17,658 with an initial death benefit of $500,000. The problem here is that he's been rated for 250%, and therefore we have a base premium of $24,279. The client was already at the top of the budget with the 20 pay if it was standard, and so this is going to be an issue for us. Now, as a side note, one of the ways that you can see for yourself that the PUAs and the DOIs are not rated is by looking at the illustration itself. And so if you notice, even though this client has been rated for 250%, the death benefit at age 85 is identical between the two cases, and as well as the cash surrender value. Now, of course, I didn't want to blind you with a whole chart of numbers, but this is to showcase that actually in every single year, the values on death benefit and cash surrender value is identical between the two cases, even though this client is rated for 250. So when it comes to Manulife Par, because our PUAs and DOIs are not rated, only the premium is different when it comes to rated cases. Okay? And you can try this with our competitors' illustrations as well. If you run a standard client and then run someone who was rated 250%, and you look at the illustration, not only is the premium higher, but you're actually also going to get a haircut on the death benefit. So anyway, back to this case. Advisor said, oh my gosh, this client got rated 250%. He can't afford $24,000. And he asked me, he said, Andrew, I remember you telling me about your paid up additions and DOIs not being rated. Is there a way, this was his challenge to me, is there a way that we can keep the premiums the same as the standard case, so 17,000, and achieve similar values? So that was the challenge for me. Okay, I had to give him a case that used the same amount of premiums, but we're not getting a haircut or a discount on the death benefit or cash value, or try to bring it closer in line. So the solution that I gave to him was, okay, I said, instead of $500,000, we're going to drop that down to 150,000 for the par side, and then we're going to utilize the term rider function again. So $450,000 T20 rider, and then we're going to use ADO. And the purpose of doing this, again, is that because only the premium is rated, if we reduce the premium amount down, then we're effectively getting rated less. And because deposit option insurance, which is being purchased by your ADO, is going to be standard, we're again doubling that effect of reducing the amount of your client's premium dollars that are going to be rated for this policy. So here's what I did. This is the original case that is standard for a standard client, 17,000. What I've done here is I've reduced the cost of insurance, which is going to be rated at 250%. The cost of that is $7,500. I have to make up the difference between this and the base premium of 17,000. So I use ADO to bring it back up so that we have equalized the premium again. And because I did 150,000 base with 450 of term rider, I actually end up with a slightly higher death benefit. So let's take a look at how the illustration runs. So the light green line is the rated case. It's been rated 250%, and you'll see that in the early years, it actually performs higher on the death benefit side. And even at year 20, when that $450,000 term rider drops, we still have a slight advantage over the dark green line, which is the standard original case. The death benefit values don't actually cross over until about age 69. And even as we push out to age 85, the difference between the two is only 6%. So effectively, for a client that's been rated 250% by doing it this way, what we've done is actually reduce the rating down to 106%. Cash values tells a very similar story. It's neck and neck until about age 65, and even at age 85, the differences hold fairly close, well within 10%. And then the main point here is we've been able to keep the premiums between the case the same. Very, very unique solution, simply because of a couple of things. Actually, let me take you through that. The only possible because, again, paid up additions, deposit option insurance, not rated, but also it's only possible because the term insurance writer allowed us to increase the Mpar, or annual contribution rule, to allow for more ADO. And the ADO is effectively buying back the rating for that client. Now, of course, this is a Manulife Par versus Manulife Par scenario that I've just shown you, but it's also very useful in comparing with our competitors as well. So I'm going to take you through that now. In the next pose, which is a competitive rated case. So third pose, standard actually versus a Manulife Par. But let me take you through the story. There's a little bit more of a setup here. Okay, so this young lady, female, 22, is looking for $150,000 of 20 pay with company B, call them. Okay, but it was also enhanced. So they went through underwriting with company B, and unfortunately, they were rated 200%. Advisor came back to me. Again, remembered this whole thing about PUAs being standard, asked me if Manulife could compete. However, there's an added challenge this time. The advisor said, can you compete against company B's standard premium while assuming that this client is going to be rated 200% as well at Manulife? Because the client was unable to afford a 200% premium over at company B. So again, I'll say, I've been given a challenge to create a client that's rated 200% to compete with somebody else's standard premium, which is also enhanced. So here's the case. I had to pivot in this particular situation to pay to age 90, effectively our life pay scenario. But in order to keep the premiums the same, I was able to do an offset in year 20. So for this client, I actually dropped face amount from 150 down to 100,000, which is incidentally the minimum face amount we need for Manulife Par. And then I added a T20 rider for 100,000. Again, this case on the right-hand side is rated. This case on the left-hand side is standard with company B. Let's take a look at the figures at the bottom here. So the 20 pay enhanced with company B, base premium is $2,000 a year, initial death benefit $150,000. For us, the cost of insurance is $1,600 a year. Okay? And I used, again, the ADO to bring that premium back up so that we match with company B. Now, for the first column here, again, premium duration, both are going to be 20 years. Just a reminder, I'm going to offset this life pay solution. Let's take a look at how it's company B. Again, with enhanced, we're looking at about close to 30 years of level death benefit, and then it starts to grow, and that's the green line here. So we have a higher initial death benefit, right? We have a $100,000 base plus a $100,000 T20 rider. Again, the term rider drops in year 20. We fast forward a little bit for company B. Their death benefit starts to grow at about age 49. If we look past out to age 85, we see quite a drastic difference in terms of death benefit. Right? So death benefit difference, we have about a 65% advantage. Cash value, again, if you didn't know this, but Manulife Par is a high early cash value product. So when compared to an enhanced situation, certainly we were higher in all years compared to company B. Now, first thing you might tell me, this is part of the conversation with the advisor is, if you're going to offset, is that guaranteed? And of course, we know that answer is a resounding no. If you want to offset, offsets are not guaranteed, which is why when we positioned this back to the client, we said, look, if you go with an enhanced, on company B, it's a 20 pay and it is 20-year guaranteed. no further payments. With the 90 pay, you need to do an offset in year 20. It's not guaranteed. However, we did a stress test for you. And we said, if you pay for this policy in this manner, if the dividend interest rate stays the same, this policy can actually offset in 9 years. So right about here. And if the dividend interest rate drops to -2%, this policy can actually offset here at year 13. So if the plan today is to pay for this policy for 20 years, then you can very confidently tell the client, yeah, as long as the dividend interest rate doesn't drop below -2, this policy can offset in year 20. So with that, we call this offset stress test passed. So again, some things to consider. No, offset's not guaranteed. So it's important to show the client that we've done the stress test, and even at dividend interest rate -2, it would have offset in year 13. So 20 years, you can be very confident that it will be able to offset. The other thing about the offset is that you don't need to do it, right? Let's consider this client. She's young, at age 22, she's already rated for 200%. If she decides to continue fund the policy, that will only add to future growth of her death benefit as well as cash value. And to pivot on the previous case that we looked at, if she decides to convert the $100,000 here, that will only add to her estate value, because odds are, if she's already being rated at 200% at age 22, the likelihood of her getting any further insurance at standard, or the possibility of her being uninsurable in the future is quite high. So this has a built-in conversion of $100,000 right here, as opposed with the enhanced. Even if she converts the remainder of her yearly term insurance, it's not going to be any more than the $150,000, at least for the first 20 years. So some things to consider there. And lastly, our lifetime deposit option limit. Even after overfunding for 20 years, the client still has $7,000 of lifetime deposit option left, which again, back to this point over here, with more future deposit, it's only going to add to future growth on her policy. So especially for someone who's been rated so severely at such a young age, this was an obvious choice for the client to bring the business over to life. Whereas with company B, again, didn't offer any deposit option room. Now, I hope that after these cases, I've been able to show you that the myth that I put up at the very beginning of this exercise was that Manulife Par is not only solely focused on the large case market. Because of its flexibility built into the feature of Manulife Par, we're able to be malleable and pivot in a lot of different client situations and fit in those unique demands that our clients have. Now, that is not to say that Manulife doesn't want to do large case. We love large case. We would gladly take your business for large cases. So I'd like to take you to our final pose, which is large case yoga. I'll take you through a casework that I've done with an advisor where we had to be very flexible again and pivot as the demands of the clients shifted. Okay. Fourth pose, large case flexibility with Manulife Par. So it's a young guy again, male 35. But this time he's looking to deposit $150,000 a year into a 20-pay policy. Now, my advisor was in competition with company X, came to me and he asked if I can do better. Now, fortunately, we were able to see the illustration for company X, and we saw that they were using $150,000 as base premium into a 20-pay policy. And with $150,000, they were able to purchase $4.7 million of initial death benefit. Now, thankfully, the advisor already came with some pre-work. He said, "Look, this is the solution that I came up with. It's $150,000 of all base premium, and in fact, you're actually a little bit more expensive than company X. Whereas they were able to purchase $4.7 million, Manulife Par only able to offer $4.2 million. Let's take a look at how the illustration runs. So initial death benefit is slightly lower, our 4.2 versus their 4.7. We do cross over at about year 13. Our cash value crosses over at about year 24. But overall, if we look at the long-term performance, we do perform better in terms of death benefit as well as cash value. But for death benefit, we're about 13% higher. And you might think, well, you should be able to convince the client to just take Manulife Par because over the long term, it performs better. However, the first challenge came up, which was this client wants to do an IFA. And with most IFAs, you really want to make sure that you drive up the early cash value so that you get a better loan structure from the lender. Now, with our cash value crossing over year 24, this is something that we needed to address. So I said to the advisor, all right, let's pivot a little bit. We're going to maintain the $150,000 deposit every year, but I'm going to allocate some of this $150,000 into the ADO. Now, in order to do that, I need to reduce the cost of insurance. So I had to drop the face amount down to $3 million. That will effectively reduce the annual premium. And the difference up to $150,000, I'm going to use additional deposit option. This is what I ended up getting. So we have an initially lower death benefit, right? Now we're at $3 million compared to their 4.7. An interesting thing happens, which is we actually cross over a little bit earlier. We cross over at year 10 instead of 13. And the cash value is now higher in all years. And lastly, another interesting thing happened with this policy is because we put in so much ADO and ADO is really driving that cash value and therefore the death benefit, we actually end up having a higher death benefit at age 85. Previously, it was 13% higher. Now we are 19% higher policy. So you might say, that's the end of it. This is great. We'll put the application in today and Bob's your uncle. But here comes the other objection. The client actually has an insurance need of about $4.25 to $4.5 million. So whereas previously we had $4.2 million with Manulife Par, we are not able to position effectively a $3 million policy back to the client, even though the cash value objective is achieved. So it was back to the drawing room. So I said, okay, $150,000 a year, but now we got to make up the difference to be able to provide the client with the insurance need that he has. So we came out with an illustration that has now $5 million of total death benefit, but what it consists of is a $2.5 million base plus a $2.5 million T20 rider. And let's take a look at what the illustration does. So now our initial death benefit is actually higher, and it's higher in all years, including when we drop the term rider down by $2.5 million. We maintain the objective of having higher cash value in all years, and interestingly enough, we maintain a higher death benefit of that 19% over Company X. This is the journey of this case where we started with a pretty simple approach, but we were able to maneuver and be flexible to address all of the needs of the clients and all the objection as it came along. So some final thoughts in this case. Again, attempt one already created better long-term values. If this was not an IFA case, we probably would have been able to just close the case using attempt number one. But because the client needs are all unique, and Manulife Par being whole life yogi, we're able to address all needs while keeping the premiums the same. We achieved a higher early cash value for the IFA purpose, and we created higher estate values in all years. And the only downside that you might tell me is that it has a term rider. We harken back to what I said before. Is it really a con to have a term rider on a Manulife Par policy, especially for someone who is 35 years old and already willing to commit $150,000 a year? This is certainly a high net worth client. If we look back at this chart, we look back at this graph, you can see that this $2.5 million is convertible in any year, even up to age 55. Now I'm showing it being dropped off here, but you can certainly continue. But for someone who is high net worth like this, he's sitting at about $14 million of total death benefit if he converts the 2.5. That not only, again, creates default lifetime deposit option, but also starts his permanent coverage at 14 million and will grow from there. So the only con or only downside is it has a term rider, but is it really a downside? So again, that is the pose called large case yoga with Manulife Par. So that brings us to the end of our practice today. And as with every yoga practice, we end with Savasana. The final thoughts that I have for you, Manulife Par, in my mind, remains one of the most flexible whole life product in the market. Now, when you're purchasing a whole life policy, you're not just purchasing the product itself. You also need to consider the overall support, as well as other. You need to consider the company as a whole, right? So I hope I can remind you of a couple of things that I think really adds to the ease of doing business with Manulife. So number one, accelerated underwriting. Quick refresher: 18 to 50, ages 18 to 50. Now we're up to $3 million of no fluid underwriting. Our EAP remains one of the easiest processes for applying digitally, especially in our current environment. A really helpful tool in your tool belt here. And large case support. This is we have recently just increased our reinsurance capacity up to $270 million. We have 6 reinsurers for large cases who are partnering with us. We have an auto buying limit of up to $60 million, and we have 10 individual underwriters solely focused on the large case market. And one more thing, I do hear in the market a lot. There's objections, or there's other rumors, or just people passing along this notion that because Manulife Par is a new product, that we're opening a new fund and there's no history with Manulife Par. And I want to take this chance to just end that rumor here. Manulife Par is not in a new fund. Okay, the fund that is underlying the Manulife Par product is the same fund that we have for PerformMax series. And in fact, on our public website, you can find the history of our par fund yield that goes all the way back to 1985. So certainly, if you hear that in your travels, that don't buy Manulife Par because it's a new fund, that it's evidently false. We are still in the same fund as before. Okay. And among when speaking of our par fund, among the big four, our par fund has the highest exposure to real estate and equities. Our asset allocation split is 60% fixed income, 40% in real estate and equities. And certainly this is what we think is the magic sauce to be able to provide us with long-term positive growth and subsequently good returns back into our policyholders' pocket. So to end out my prepared comments today, this is something I've been telling all of my MGAs. Webinars are great, especially with COVID. We've done a lot of webinars, but casework is best. It is honestly the best way to learn about a product, to get into the nitty-gritty of how a product works, and it really helps to develop a relationship between advisor and wholesaler. So I encourage you to reach out to your Manulife wholesaler today to work on cases together and really learn the intricacies of what makes Manulife Par one of the most flexible products in the market today. So I think we have some time for Q&A, but before we do that, I want to leave you with today's, the second half of today's code is highlighted in the bottom left-hand side here. I've already provided first 3 digits. Now it's the last 3 digits, so please take a moment to jot that down. If you haven't done this before, all you need to do is take the full code itself, go to Manulife Advisor Portal, go to the CE Center, and enter the code into the My Certificates tab. And again, for those in Alberta and Manitoba, it's still being accredited by the government bodies there, but it'll show us pending on Advisor Portal, but you'll be credited as soon as it's approved. So I leave that up. I know that it was a little bit distracting, but I had all the chats coming in on the top right-hand side. I don't know if there's any questions that are still outstanding.
Andrew, I think for us all to hear is on some of this casework, is there a ratio of what we should look at for base versus term, or can you walk us through your process of how you get through this?
That's a great question. The rule of thumb. So I do have a lot of case work where I have that term fitted on top of the Manulife Par. My personal rule of thumb is I don't like to put a ratio of term rider more than 4-1 against the Manulife Par. As in, if I have $1 million par, the upper end limit of the term rider that I would put is probably about 4 million. So I don't like to go past the 1-4 ratio, and the reason for that is because the term rider eventually needs to be dropped. Either it's converted or you need to surrender it altogether. And if you have a term rider that's too large, you're doing a disservice to the client, because what you're going to see when we see that drops in the graphs is a very drastic drop. And so if the purpose today is to make sure that the client has adequate coverage, I don't like to go over that 1-4 ratio. So I hope that answers the question there.
I think so. Thanks for answering, Andrew. There's one other question. William just expanded on that. He had mentioned, I heard the ratio is 1-20. Is that ever advisable?
1-4. 1-4.
Yeah, so 1-4 is what we'd be looking for there, William. There was one other question here from Jeremy Weeb, and it's surrounding the assets within the PAR fund. Jeremy, we do have a full PAR fund guide for you here, but Andrew, I don't know if you wanted to tackle this one or share the booklet regarding many alternatives and private assets in our PAR fund, similar to what CPP and other pension funds are doing, since yield is a challenge in the current low interest rate environment. We have that private real estate and equity assets there, like you mentioned. Was there anything you wanted to expand on?
I mean, if you want to do a deep dive into our PAR account, I welcome you to take a look at, and I'm sure you can see my screen here, to go into our annual report, and we actually do a really detailed dive into what our holdings are. And this is all available on Advisor Portal, by the way. And we can actually look into, I've saved a couple of files here, but total mortgage allocation, total equities allocation, but we also have a more general holdings diagram or breakdown of what we hold in the PAR. I'm not too familiar, Jeremy, with what we have or what CPP has or what the other pension funds do. But certainly, if you want to do a more investigation, more research into what we hold, these are available to you to do more research there.
Yeah, and I'll get those over to Lisa, and then we can maybe expand on the PAR fund holdings. Get that over to you yourself, Jeremy, and to those on the call.
And for your last comment there, Jeremy, yield certainly is a challenge in the current environment, and that's certainly not unique to just what we see on the Manulife Par Fund. Much of our competitors have also come out with similar experiences. But I'll emphasize the last point on one of the final slides there, which is we do think that our 40% exposure to real estate and equity is something that will help us drive future growth or long-term growth, and certainly with a 60% fixed income foundation to sort of smooth that out. I think this is the winning winning asset allocation for us. I see one here from William. How low do you think the dividend interest rate will go before it reverses? That's a great question. Well, William, we actually posted a dividend interest rate expectation. I welcome you to check that out. We have three sort of scenarios where we think the dividend interest rate will go. and our competitors have certainly come out with similar publications. If the current one of the key major factors that influence dividend interest rate is, of course, interest rates in the market, and if we continue along current rates, prolonged low interest rates, yeah, the dividend interest rate will drop, and that's similar to again what our competitors have also come out with. If interest rates rise, then our dividend interest rate will rise with it, and certainly I'm unable to to look in a crystal ball, and of course I would love for the dividend interest rate to raise, but it really depends on the market. Is there a lag time when? So, William, I'm guessing your question is if the interest rates do rise, is there a lag time for it to be reflected in our dividend interest rates? I would assume so, because we do have a 5-year smooth on our par fund. So if there's a drastic raise in the interest rates, certainly we're not going to see a drastic increase on our dividend interest rate right in the very following year. So there, I would assume there to be a level of lag rates, but the same thing would happen if interest rates drop. When 2008 happened, that our dividend interest rate didn't fall by 4% a span of 1 or 2 years. It took some time for it to come down. So. Okay, well, thank you again for having me, and I'll hand it back to Lisa. Thank you, everyone.
Well, thank you, Andrew. Thank you, Cody. Thank you for all of you who joined us. I appreciate everybody's flexibility and their ability to pivot over to join us here on WebEx. We had great attendance. Cody will be sending me links and PDFs to everything that they mentioned here. We will post them on IDC Win Big, and also watch your IDC Win Bulletin, and we'll have all the links available for you there. Again, thank you, Andrew and Cody, and hope to see all of you join us on Frank Abate's webinar. Thanks, guys.